next speaker, Mr. Rounak Gairarey, Senior Analyst, Zinc Value Chain from BigMint Technologies, who will take us through a detailed analytical view of the zinc market, covering price trends, demand supply, positioning, and key indicators shaping the outlook. It is interesting to note Rana Grare is a metals and commodity market professional with over 10 years of experience in the metal sector, specializing in zinc and lead markets. As senior analyst at Bigment, he leads the zinc and lead segments, delivering insights on price assessment, trade analytics, and market dynamics across both primary and secondary markets, including zinc byproducts such as dross and oxide. Prior to this, he handled the steel sector, gaining extensive experience in market analysis and industry trends. Ronak actively engages with industry stakeholders to develop data driven insights and contribute to the greater market transparency. We keenly look forward to hear him. With this, over to you, Rana. Let's have your perspective.
Thank you, ma'am. Good afternoon, everyone, and welcome to today's webinar. Thank you, Beena ma'am, for the introduction. Before we dive into today's presentation, let me quickly take a minute to tell you what BigMint is all about. BigMint is a trusted platform that provides price reporting, market intelligence, and consulting specifically for commodities. We cover a wide range of markets like ferrous, non-ferrous metals, coal and energy, scrap recycling, logistics, and agriculture. Our services include price indices, futures data, news and insights, reports, tenders, events, consulting, and even price forecasting. Everything you need to stay on top of commodities market. Let me quickly walk you through what we will be covering today so you know what to expect. We will start with the global zinc supply and demand. A key 19,000 ton deficit is projected for 2026. We will then look at the LME zinc price trend, where prices stand today and what's driving them in 2026. After that, we will examine India-specific consumption patterns, the secondary market for dross and oxide, and the import parity situation as it stands today. Then we will move into treatment and refining charges, zinc consumption, secondary market trends of India, import parity of zinc ingots. Finally, we will close with the zinc risk factors every market participants will should be tracking through the rest of the 2026. Let's look at the big picture, the global zinc supply and demand balance. The headline for 2026 is a deficit of 19,000 tons, but to really appreciate what that means, let me give it some important context. To understand where we are today, it helps to go back a decade. Between 2016 and 2022, the zinc market swung sharply between surplus and deficit. The biggest surplus came in 2020, 344,000 tons, driven entirely the pandemic-related demand destruction, while smelter output stayed steady. We also saw surpluses in 2016 and 2019, but the market flipped to deficits in 2017, 2018, 2021, and 2022, reflecting tightening mine supply and recovering demand. Then in 2023, the market swung back to a large surplus of 252,000 tons before returning to deficit again. 69,000 tons in 2024, narrowing further to 33,000 tons in 2025. Concentrate tightness persisted through this entire period. Treatment charges fell to just around $60 per ton, and combined LME SHFE exchange inventories declined by 77,000 tons to around 739,000 tons. So now in 2026, the market remains in deficit, a narrow 19,000 tons, but the deficit nonetheless. This is not a bearish picture. Mine side constraints, low exchange inventories, and concentrate scarcity continue to keep the balance tight and put a floor under LME prices. Let's talk about where LME zinc prices stand and where they are headed. The average LME spot prices in 2025 came in at dollar 2,867 tons, right, up from 3% from 2024. While that's a modest gain, the important story is the volatility. Realized 90 days volatility has risen to 22% compared to 15% in 2024, reflecting how much more uncertainty the market is pricing in. For 2026, the market consensus range sits between $3,000 and $3,400 per ton. Let me walk through the five key drivers behind that range. First, mine supply. Majors like Trafigura and Glencore are seeing concentrate flow tightening. These directly reduce the raw material available to smelters globally. Second, China smelters cut, power rationing in key provinces like Hunan and Yunnan, combined with weak smelting margins, have forced output reduction. Third, EV and infrastructure demand. Galvanizing steel for bridges, EV chassis, and construction continues to support physical zinc demand. Fourth, aluminum inventories. Stock are sitting at around 180,000 ton, well below the 5-year average of 320,000 ton. Low stock means any demand spike quickly translate into price pressure. And fifth, the macro backdrop. A weaker US dollar broadly support base metal prices. The upside risk to that $3,500 ceiling comes from a further drawdown in LME stocks or additional mine closure. The downside risk is a sharper than expected Chinese demand slowdown. Treatment and refining charges, or TC, are one of the most important signals in the zinc market, and they tell us a lot about where supply and demand are balanced at a mine level. To understand today's situation, let me give you a quick history. Back in 2020, spot TCs peaked around $300 per ton. That was a smelter's market. Concentrate was abundant. Mines were producing freely, and smelters could extract high processing fees from miners. Fast forwards to late 2025, and spot TCs had fallen sharply to just $80 per ton. The reason is clear: mine closure, Century in Australia, Zarim in Kazakhstan removed significant concentrate supply from the market. At the extreme, spot TCs briefly touched near zero. For 2026, we are expecting a partial recovery to around 90 per ton, with the benchmark annual range settling between $100 to $110. But the market is not expecting a quick return to those 2020 levels. The recovery lag would last multiple years. Why does this matter for India? When TCs are low, it becomes more economic for India's domestic smelters to import finished refined metals. SHG zinc, rather than purchase concentrate and process it themselves. This is one reason import parity has become a live conversation for Indian consumers this quarter. Now coming to the import exim section, that part. India's zinc consumption has grown strongly at over 8% CAGR in recent years, reaching 1 million tons with steady year-on-year growth. However, domestic production has remained largely range-bound at around 0.85 million tons, widening the demand-supply gap. As a result, imports have increased, while the export surplus has gradually reduced. Galvanizing continues to dominate, contributing over 70 to 72% demand, driven by infrastructure, transmission, and construction. As infrastructure steel consumption rises, zinc demand scales directly. Beyond these alloys, zinc wire, and battery segments are also seeing healthy growth. The CAGR of battery sector is very much 10% of CAGR from 2021 to 2025. Overall demand is structural and accelerating, and with limited domestic supply growth, India's reliance on import is expected to increase further. Now coming to the pricing part. In India, zinc prices strengthened on a year-on-year basis in 2025, supported by firm domestic demand, higher input cost, and supporting global cues. BigMint X's zinc ingot prices in North India rose from around 2,63,500 in CY 2024 to 2,83,300 in CY 2025, marking a 8% increase year on year. In West India, prices increased 7%. Let's turn to a secondary market, which is increasingly important for a large segment of Indian zinc consumers. India's secondary zinc market covers zinc dross and byproduct of the hot dip galvanizing process, zinc oxide and remelted zinc ingots over the last 18 months. The prices spread between primary SHG ingots and secondary grade material has widened meaningfully, making secondary zinc an attractive input for applications where purity requirements are lower. In 2025, secondary zinc prices tracked LME with a typical discount of 10 to 14%, though that discount narrowed in the Q4 2025 as draws generation volume dipped. For 2026, we expect secondary prices to remain correlated to LME trends, with the discount band likely ranging in the 8 to 12% range as more galvanizers optimize their ROS recovery process. Now, this slide gets to the heart of what many of you are most interested in. Should I be importing zinc right now or buying from ILZDA domestically? We have run a live import parity calculation as on 13th April, and the answer depends entirely on whether you have duty-free access. Let's look at the non-duty paid scenario first. Taking LME cash at $33.66 per ton, adding freight $45, FOB port charges of $95, the basic custom duty of 5.5%, which works out to $185 per ton, and port and clear cost of $20. The total landed cost comes to $3711 per ton. ILZDA domestic price on 13 April was 3,42,700 per ton, which translates to approximately $3673 per ton at current exchange rate. That means importing without a duty benefit costs you $38 more per ton than buying domestic. Import parity is not favorable here. Now the duty-free scenario with the same LME base, but adding a market premium of $250 per dollar instead of paying custom duty and the same port charges, the landed cost drops to 3636 per ton. Against ILZDA's 3673, you actually save $37 per ton by importing. The window is open, but it's not but it's narrow. The message is clear. If you have access to duty-free import channels, to use SEZs or specifically trade agreements, there is a selective import opportunity in Q1, Q2 2026. For those paying full BCD, domestic procurement remains the better option at current prices. Now, where we are going, look, things to watch out in 2026. We are now going to look at the 8 risk factors that could significantly move zinc market through the rest of 2026. I would encourage you to keep this on your radar and build them into your procurement and hedging strategies. First, mine supply, restart and closure. Watch Tara in Ireland, Carabao in Canada, Zaram in Kazakhstan closely. Any production ramp up from these sites would ease concentrate scarcity. Conversely, any price closure would spike LME price quickly. Second, Peru and Latin America, community blockades at major mines like Antamina and Cerro Lindo have historically caused sudden EC spike. Labor contract renewals in Q2 2026 are worth monitoring. Third, China's smelter utilization. Power rationing in Hunan and Yunnan between June and August can cut output by 8 to 12%. Any energy stimulus from Beijing, on the other hand, could flip the refined supply outlook. Fourth, Indian infrastructure execution. We BigMint projects India's zinc demand to reach approximately 2 million ton by FY 2030, implying a CAGR of around 8.5%. The pace of infrastructure spending, especially roads, bridges, and urban housing, is the key variable. Fifth, the US dollar and INR volatility. If US INR moves above 93 or 94, import costs rise sharply. Monitor RBI intervention and US Fed rate decision closely. Sixth, India trade policy. Any change in 5.5% BCD or progress on India Gulf Cooperation Council or India UK Free Trade Agreement negotiations would fundamentally reshape import economics overnight. Seventh, LME warehouse stock drawdowns. Stocks are already at 180,000 tons versus a 5-year average of 320,000 tons. A drawdown below 1 lakh tons could trigger algorithm buying and rapid price spikes. Check weekly LME warrant data. And 8, EU energy cost. If European gas price respiking above 40 European per megawatt, Nile Balen and Glencore Portuguese may idle again, permanently removing 150,000 to 2 lakh tons of European refined supply from the market. 8 factor collectively define the range of outcomes for zinc prices in 2026. Being on top of them gives you a real decision making edge. I think that's now time. We are hosting BigMint India Non-Ferrous Week 2026 on 9th and 10th June in Mumbai, bringing together the entire non-ferrous metals and recycling ecosystem to discuss market outlooks, trends, and opportunities in depth. And for all of you who joined today, we have put together an exclusive offer. You get 10% off per delegate on the registration fees. And if you registered 2 delegates, you unlock an additional 10% off. Now here's the key things to keep in mind. The offer is valid only for today and tomorrow, and it exclusively available if you register through the link shared in the chat box. So don't miss out. It's a limited time benefit just for you. Looking forward to see you all in Mumbai. And that brings us to the end of the today's session. Thank you all of you so much for your time and your attention. I hope the data and analysis we have shared today gives you a clear picture of whether the zinc market has headed and how to position yourself for the rest of the 2026. Thank you again and have a great rest of the year. Thank you.